Americans are panic selling everything. You're hearing about layoffs and people selling everything from stocks to crypto and even the boring funds they swore they would never touch. Charts are red, the office is tense, and your brain is yelling, get out before it gets worse. If that is you, you are not crazy, but you are standing in the exact spot Wall Street wants you. This is the point where regular people dump years of savings and the guys with cash start picking up those same assets at a discount. That is the side of the story you almost never hear. On TV, they blame fear or headlines, but in real life, a lot of this selling is forced. In this video, I'm going to show you how layoffs, margin calls, and those red bars on your screen work together to push Americans out of their best assets at the worst time, who is quietly buying on the other side, and what I am doing with my own money so I do not end up as the exit. As I am recording this, the screens in front of me are a mess. We have just had days where big tech companies are down double digits, Bitcoin has dropped tens of thousands of dollars from its recent peak, and both silver and gold have taken sharp hits on the paper market. At the same time, a lot of physical dealers are still talking about tight supply and stubborn premiums. This is supposed to be the quiet part of the year. Funds are usually repositioning, companies are updating guidance, traders are complaining about boring sideways action. Instead, it feels like we are seeing the start of a fire sale, while headlines talk about the first wave of layoffs. Before we go any deeper, do yourself a favor. Take a breath. Do not panic sell anything while you're half awake, angry, and scared. Watch this video to the end, because what is happening on your screen right now does not line up with how a healthy market behaves. And if you understand what's truly going on, you may have a shot at surviving and maybe even coming out stronger. All right, let us get into it. You keep hearing the same story. Stocks are down because earnings will be weaker. Crypto is down because the dream is dead. People are selling because they finally woke up. Most people think that when you see a big red candle, it means thousands of calm geniuses sat down, read all the latest economic reports, and decided that asset is worth less. In reality, a huge share of the selling in moments like this comes from fear, plus leverage, plus job risk, all mixing together like gasoline. Let me show you how that works with one simple example. Imagine you moved part of your retirement money into Bitcoin near the top of this cycle. You did not take out credit cards. You did not use crazy leverage. You just rolled some money out of a retirement account because everyone around you was saying the same thing. By the middle of this decade, it will be $500,000 a coin. By the end of the decade, it will be $1 million. You buy at, say, $110,000 a coin, and you pick up 2 coins. That is $220,000 of your life savings. Then the party continues. Bitcoin spikes to around $120,000, and for a minute, you feel like a genius. On paper, you're up $20,000. Fast forward to this week. Price slams back down to the low 60s. Now your 2 coins are worth a little over $120,000. You're down roughly $100,000 from your entry, and about $120,000 from the peak you were mentally spending. I'll let that sink in. In a few violent days, you just watched the price of a house vanish off your screen, even though you never sold a thing. Now layer on something else. Your company starts hinting about cost cuts, hiring freeze. We are evaluating headcount. You see friends on social media posting about getting let go from big-name tech firms. Here is the key point. The chart on your phone and the email in your inbox start talking to each other inside your head. You're no longer just down $100,000 on a speculative bet. You are imagining being down $100,000 and unemployed. That is when people hit sell, not because the long-term thesis changed, but because their personal risk went through the roof. If you add margin to that story, it gets even nastier. Say you did not just buy the 2 coins outright. Say you put up half the money and borrowed the rest inside a trading account. When the price drops by almost half, your equity is almost wiped. The broker does not care about your feelings or your job prospects. They care about their loan. They send you a margin call, and if you do not wire more cash, they liquidate you into the hole. Most people think they are making thoughtful decisions in these moments. In reality, the system is set up so that once the move starts, a chain of forced actions kicks in. Retail sells from fear. Leveraged holders sell because they have no choice. Funds that promised tight risk-controlled dump positions to stay within their models. Understanding this difference between your feeling and the structure is not just theory. Misunderstanding. This is costing people peace of mind and real money every time the market has a tantrum. We have seen this movie before. In March of 2020, when the world shut down, stock indexes dropped by more than 30% in weeks. Headlines said it was the end of the old world and people dumped stocks and metals just to stop the pain. 6 months later, those same indexes had clawed back most of the losses and then kept going. The fear in people's heads lasted longer than the crash on the chart. In 2022, when rates jumped, big tech names that were supposed to be untouchable were cut in half and written off as dead. Yet by late 2023, a lot of them had either reclaimed old highs or come close. Metals have run the same pattern for years. Paper price gets slammed, people scream collapse, and yet physical buyers who stayed calm found that dealers never really put silver and gold on a true clearance rack. Spot bounced while anyone who sold at the bottom had to rebuild their stack at higher prices. We will come back to what smart players actually do with this panic, but first, we need to connect this to the thing that really keeps people up at night right now. Layoffs. Everywhere you look, you see the same pattern. Big names announce small restructuring with strategic review, right-sizing. You watch them cut entire departments while executives talk about efficiency. During the last big tightening cycle in 2022 and 2023, tech companies announced well over 100,000 layoffs, with tens of thousands coming from the biggest United States names alone. That was during a period when many of them were still profitable, still buying back their own stock, and still handing out bonuses at the top. The layoffs were not just about survival, they were about keeping Wall Street happy with margins and earnings per share. Now zoom in on today. Market sells off fast, valuations compress, boards start asking the same question. How do we protect the share price and our stock-based compensation if this slowdown sticks? Cut costs, cut staff, cut projects. So when you hear labor pains deepen as tech leads a broad market sell-off, translate that into plain English. Corporate America is getting ready to defend its numbers, and if that means sacrificing tens of thousands of workers to make the next quarterly call sound good, they will do it. This is the part nobody wants to say out loud. In practice, the incentives in the system often end up preferring a pretty stock chart over job security for workers. There's cold arithmetic behind that. When a share price has already dropped, every dollar a company spends on buybacks cancels more shares than before. Fewer shares with the same total profit means earnings per share look better, even if the business feels worse to employees. When they cut headcount and delay projects, payroll and other costs fall fast, which can make profit margins pop in the next few quarters. Boards and executives are paid mostly in stock and options, not in a simple salary. Their bonus plans live and die on earnings per share and the share price, so they have every reason to pull the layoff lever to make those numbers move. In a slowdown, layoffs are not just a last resort, they are a tool to defend the stock and the compensation tied to it. Now imagine being one of those workers. You see your company's stock down 10% in a week. You see Bitcoin and other risk assets down 20-30% in a blink. You see headlines about hiring freezes. Of course you are panicking. You're asking the same two questions I keep seeing in my messages. How do I stop the bleeding in my portfolio? And will I still have a job to pay my bills? And here is why that fear feels so loud right now. In the United States, a huge slice of households live close to the edge. Surveys show a large minority of families would struggle to cover even a few months of bills if the paycheck stopped. And millions of people have more on high interest cards than they have in savings. So when they watch a retirement account drop by 10 or 20% at the same time, rent, food, and gas all cost more. It does not feel like a paper loss. It feels like the one thin cushion they had is being kicked out from under them. Most people think those are separate questions. In reality, they feed each other. Fear about your job pushes you to sell low just so you feel safe, selling low locks and losses that make you even more anxious about your future. This is exactly where the structural antagonist in this story shows up. No, it is not one cartoon villain. It is a set of incentives that run through Wall Street, big corporations, and the trading platforms you use. On one side, you have large institutions, funds, and corporate insiders that are not using their rent money to trade. They can sit through volatility. They can buy more when things are cheap. They have teams that model different scenarios and decide how to exploit forced selling. On the other side, you have millions of ordinary people, many of them in the United States, who are tying their savings and their sense of security to lines on a screen. They are using brokerage apps that gamify every tick. They see instant loss numbers flashing in their face 24/7. Inside that, you can break it down even more. First, you have regular traders and small investors using margin and options. When prices dump and volatility jumps, their apps flash warnings and start closing positions because the broker is protecting its loan, not the customer. Then you have funds that live by risk models. When volatility spikes, those models tell them to de-risk, so they sell even if they still like the asset. Finally, you have the people who are almost never forced to sell. Corporate insiders with stock grants and big pools of cash can wait. They place low bids far under yesterday's price and let fear drag the asset down into their buying zone. The people in charge of the system do not need you to blow up. They just need you to be scared enough to sell to them at the wrong time. They gain discounted assets and control. You risk selling your future for the price of one bad week. We need to talk about what is real and what is theater here. Take the metals market for a second. On your screen, silver looks like it fell down an elevator shaft. The spot price is smashed lower in a short window. Gold gives up weeks of gains in a handful of sessions. Most people think that means demand dried up and nobody wants the metal. In reality, in a lot of the sharp takedowns we have seen in recent years, reports from mints and dealers in the United States, Europe, and Asia tell a very different story. Premiums over spot do not always collapse. They often rise instead. Certain coins and bars go on back order, and some shops quietly put limits on how much they will sell to each customer. You cannot have "nobody wants this," and we are limiting orders at the same time. That is not a free market. That is stress showing up in the plumbing. On the metal side, a lot of that move starts in the futures pits. A few very large sell orders can hit quiet trading hours and knock the quoted price down fast, even while coin shops are still ringing up orders from real buyers at higher all-in prices. The screen says, "Silver just got cheaper," but the person trying to buy a tube of coins sees almost no discount after premiums. In crypto, the gap is similar. Only a slice of the total supply sits on exchanges ready to trade. So a burst of market sell orders through that smaller pool, especially overnight or on a calm weekend, can air pocket the price without any change in the long-term story. Look at crypto. On paper, millions of coins sit on exchanges ready to trade at a moment's notice. In practice, a large share is locked in cold storage or tied up in corporate treasuries and funds that are not dumping at the first sign of red. The actual amount sloshing around at the margin is much smaller than the headline number, which means when panic hits, a few big market orders can move price in dramatic fashion. Now connect this to the job market. In the official data, unemployment might still look low. Politicians stand up and brag about the rate. But under the surface, you see the cracks. Full-time roles becoming part-time, contractors getting cut first, people taking second jobs or side gigs just to keep up with rent and food. You saw this during the pandemic crash in March of 2020. Markets fell at record speed. Millions of people lost jobs or were furloughed. The headlines were pure doom. If you had been able to see 6 months into the future, you would have watched one of the fastest rebounds in modern market history. Stock indexes not only recovered, they went on to hit new highs. People who bought real estate, solid companies, or quality crypto during that panic saw life-changing gains. People who sold everything at the bottom locked in pain and then had to watch the recovery from the sidelines. I'm not telling you that history will repeat perfectly, but I am telling you the rhyme is familiar. Right now, the surface story is simple. Americans are panicking, selling everything. Layoffs are starting. The dream is over. Underneath that is the longer story. The system is trying to flush out weak hands, reset prices, and then rebuild on the backs of the people who gave up. If you think this is just dramatic language, look at how corporate and market cycles actually work. When times are good, companies hire aggressively and take on projects that only make sense in a boom. They stretch, they grow headcount, they launch new divisions. When the cycle turns, they do not move gently, they cut hard. They announce round after round of layoffs, sometimes even as they brag about strong balance sheets. This is not simply about survival. It is about sending a message to investors that they are serious about discipline. Meanwhile, central banks and policymakers play their own game. They keep talking about soft landings and transitory pressures. It can feel like the strategy is to keep you calm enough to keep consuming, but not confident enough to demand wages that keep up with real inflation. So where does that leave you in this mess of charts and press releases? First, you need to separate paper fear from real-life needs. Ask yourself a few simple questions. Do you need to sell this asset today to pay rent or buy food? If the answer is yes, you do what you have to do for your family, and there is no shame in that. Survival comes first. If the answer is no, then you're not making a survival decision. You're making an emotional one. You're selling because the red is screaming at you, not because your thesis expired overnight. Second, you need to understand what kind of asset you are holding. Is this a solid company with real cash flow that you believe will exist 10 years from now? Is this a high-risk meme coin that only works in a mania? Is this metal that you bought as insurance rather than a lottery ticket? Most people throw everything into one emotional bucket called my investments. In reality, each of these plays a different role. Insurance works differently from a gamble. Owning a share of a profitable business is not the same as holding a lottery ticket. Third, you have to be honest about your time frame. If you bought something because you believed in a 10-year story, but you're ready to sell it after 10 days of pain, the problem is not the asset, it is the mismatch between your stomach and your plan. Toward the end of this video, I promise to show you the two groups this moment creates. Let us do that now. Group 1 is the panic crowd. They look at their portfolio every hour. They react to every headline. When prices fall, they sell to make the bad feeling stop. They tell themselves they will buy back later when it feels safe. But by the time that feeling returns, the bargains are gone. The system loves this group because it needs someone to absorb the losses when things break. Group 2 is the deliberate crowd. They still feel fear. They are not robots, but they use it as a signal to slow down, not to speed up. They look at their cash position, their job stability, their time horizon, and they adjust on purpose, not in a blind rush. They refuse to use margin they do not understand. They avoid going all in on any one story, no matter how shiny. They know there will be other chances. I'm not here to tell you which group you belong in. I'm telling you the game is designed to push you into the first group, and you have to fight that if you want to survive long term. Here's what I am doing personally, and this is not financial advice. First, do not add new leverage into a falling market just because you are afraid of missing a bounce. Borrowed money turns a rough patch into a margin call and hands control of the sell button to your broker. Second, do not sell the few things that actually protect you just to chase a dip somewhere else. Dumping your cash buffer or your safest assets so you can gamble harder usually leaves you with more risk and less sleep. Third, do not try to rebuild your entire financial plan at 2 a.m. while you scroll red charts. Big changes made in peak fear almost never age well. I'm not selling quality assets just because this week hurts. I'm not adding leverage. I'm keeping extra cash for real emergencies, the kind where a job truly disappears or a major expense comes out of nowhere. I'm using this panic as a stress test for my own positions. If there's anything in my portfolio that I cannot hold through a 50% drawdown without losing sleep, I ask myself why I own it at all. Most people think the key to wealth is finding the next hot ticker. In reality, the key is surviving the ugly parts of the cycle without blowing yourself up. 6 months from now, you will look back on this week one of two ways. Future. You will not remember every headline or every intraday spike, but you will remember whether you kept your nerve or handed your best positions away at a discount. You will remember if you acted like someone with a plan, or someone who let the feed do the thinking. Either this was the moment you let fear drive the wheel and you sold your best assets to someone calmer than you, or it was the moment you learned how the system uses layoffs, headlines, and red charts to shake you out, and you decided not to be the easy target. 5 years from now, people will tell stories about 2026. They will talk about the scare, the layoffs, the sell-offs. Some of them will brag about how they bought when everyone else was dumping. Some of them will quietly admit they sold at the bottom and spent years trying to catch up. The difference between those two stories will not be one perfect trade. It will be a handful of choices in weeks like this when everything felt like it was on fire. Those choices either train you to stop being easy prey or lock you into the role of exit liquidity every time the cycle turns. You get to choose which one you are. Do not let them turn your panic into their entry point. Do not be the cheap exit liquidity they need to reset the board. Do not sell your long-term insurance to the same structure that lit the match. If this helped you see the pattern a little more clearly, do 3 things. Screenshot this video or save it so you can come back to it the next time the market freaks out. Share it with one person you know who's on the edge of smashing the sell button right now. And subscribe, hit like, and tap the bell so you do not have to face the next wave alone. You cannot control the headlines. You cannot control what your company does with its payroll, but you can control whether you move like a scared stampede or like someone who finally understands how the game is wired. Take a breath. Protect your real life first, then make your moves with a clear head, not a shaking hand.